lovers and friends, a warm welcome to Financial Freedom with Honeybee. My name is Malwandla Hanare, and on today's episode, we're going to talk about income tax. So it's very important to understand income tax because taxes is one of those things that can eradicate your wealth. Please note that in my channel, I am taking you guys through my own personal journey to financial freedom. So anything that I say in this channel doesn't constitute financial advice. If you are looking for the services of a financial advisor, please be in contact with a registered, qualified financial advisor. So today we're going to talk about income tax, and please, if you haven't subscribed to my channel, please subscribe, please like, please talk to me. Let's help each other grow, and let's basically journey together to that financial freedom that I am busy chasing. I hope you're also chasing your own financial freedom, right? So today we're going to look at income tax. So in South Africa, if you earn an income, then you are liable to pay income tax. So on the income tax that we're going to look at is for somebody who is working in South Africa. So if you are working outside of South Africa, I don't know how that one works, but we're going to look at if you are in South Africa and you're a South African, or somebody who works in South Africa that pays tax. So yeah, so this is you that I'm talking about. So if you are working abroad and you're a South African, I don't know how that one works. So let's focus on you being in South Africa and working in South Africa and liable to paying the SARS or the South African tax, right? So how income tax works is there's different incomes that you need to understand. So the first one is your total cost to company. So your total cost to company is your gross salary plus all the benefits that the company is paying towards you. So your total cost to company, it constitute your gross salary, and this salary is the one that we call it pensionable income. So your pension comes from your gross salary, and then the benefits that you get from the employer added to your gross salary, that constitutes your total cost to company, right? So your total cost to company is your gross salary plus your benefits, or the benefits that the company is giving you. So the benefits normally are things like if they are contributing towards your medical aid, if they are contributing towards your retirement annuity, your UIF, all those things that they are contributing towards from their side, that constitute the benefits, and then plus your gross salary, that makes your total cost to company. And then your pensionable income basically is your gross salary when you remove all the company benefits. So that pensionable income, that's where you can determine the maximum taxable benefits that you can get, because with retirement annuity or retirement, you can contribute up to 27.5%. So the 27.5% is from your pensionable income, not from your total cost to company, right? So it's very important to understand that it's only from your pensionable income or your gross salary where you can contribute, not from your gross plus the benefits, no, only from your gross salary. And then once you can be able to determine that, is you need to also determine your taxable income. So the taxable income, this is what you get taxed. This is what determines the tax bracket that you fall under. So your taxable income is your total cost to company minus deductions. So these deductions, or these deductions that are basically allow you to not pay tax on, is things like your retirement benefits or your retirement annuity. So if you are contributing towards your retirement, whatever you are contributing, they take it before they tax you. So that's why when you go and withdraw your two-pot system, then they now want to tax you, is because when you contribute towards your retirement, that was before you paid tax, right? And also the reason that they put it under your income now when you go and withdraw is because you are not retired, or you are not unemployed or fired, where you have to basically use the retirement tax tables. So that's why when you go and withdraw from your two-pot system, it counts as an additional income, and then they tax it accordingly to the tax bracket that you will fall under with the money that you've added, right? So it's very important to understand that when they take out money for retirement, this is before they tax you. So they allow you to remove that money. And also, if you are donating, somebody who donates to NGOs that have tax numbers or that are registered with SARS for tax benefits, you can also be able to remove whatever you've donated. They will give you a certificate where you can prove to SARS that you've donated so much money. And yeah, I think they only allow you to donate up to 10% of your taxable income. I'll just have to verify that. But there's an allowable, the maximum that you are allowable to donate. You cannot just donate your whole salary so that you don't get taxed. There's a maximum limit for you to donate. So there's also other things that you can remove, but in most cases, it's only, for most people, it's only the deduction that is related to your retirement annuity. So they remove the retirement annuity and the rest of the money gets taxed, right? So that's how you determine your tax bracket. So you take your total cost to company with the benefits, and then you minus whatever you're contributing towards your retirement, and then whatever money that you've got on a monthly basis, you multiply that by 12, and then basically you annualize it, and then you can be able to see which tax bracket you fall under. So if you look at this equation, basically your taxable income is equal to your total cost to company minus deduction. So in this case, if you are like myself who has a retirement annuity only, so it's your total cost to company minus your retirement annuity, and then that determines your taxable income. So if you look at it, you only have your retirement annuity to maximize to be able to reduce the taxable income, because if you've got a less taxable income, that means less tax that you pay. So if you are having maybe 12% that you are contributing towards your retirement, you're probably going to pay more tax compared to somebody who's paying or who's taking out 27.5% towards their retirement. So that's how you determine your taxable income, and that will help you to determine your tax bracket that you fall under. But what's nice is if you belong to a medical aid and you are the main member of that medical aid and you are paying it through the salary, is you also get tax credit. So this tax credit is if, for instance, you were supposed to pay 2,000 on tax, so they give you the medical aid tax credits, and then those help you reduce your tax. So for instance, if it's only you on the medical aid, you get 346 tax credit. So if you were to pay 2,000 on tax, then they remove that 346, you only pay 2,000 minus the 346. So if there's two people in your medical aid, it's 728, but the third, the fourth, the fifth person that you add on the medical aid is now 246. So the more people you have on your medical aid, the more tax credit you have. That means it will also lower your tax contribution, right? So I'm not saying you must go and make 50 kids so that you can have the benefit, but the more people you have on your medical aid, the less tax you're going to pay because of the tax credits that you're going to have per individual that you have insured with your medical aid. So the first two people, it's 728, and then anyone after is 246. So this is on your income. So also, if for instance you've got a property and in that property is registered under your name and you've got an income out of that property, that money that you get or the profit that you get from that property also gets added into your taxable income. So it's part of your income. So it gets added into your taxable income as a second income, and it must be taxed accordingly. So another place where you can have an income that is taxable is if you have money saved in the bank, or if you've got an IT3 form which comes from interest income. So interest income, they declare it in an IT3 form. So if you've got an IT3 form, you've got money that is saved and you earn interest on it, then that interest also pays in tax, and you can only make 23,800 per tax year. That doesn't pay tax. Anything that you make above the 23,800 rand, you need to take 40% of it and they add it into your income, and that way they tax it, right? They tax it on the tax bracket that income will lend you in, right? So if you want to know more about this interest income, I did make a video about interest income. Go and learn about it and see how you can optimize your tax basically the tax that you're supposed to pay if you do not have these things, the optimizing ideas to optimize your tax, right? And then the third one where you pay tax in an income is if you've got dividend income. So dividends income is that income that companies pay their shareholders when they've made profit. So on the dividend income, the tax there is 20%. So what's nice with dividend income is, let's say they've paid dividends in whatever platform that you're using to buy shares. So whatever dividends that they pay you, they already took out the 20%. So you don't have to go to SARS and pay that 20% yourself. So before they pay you that money, they take away, all the owner of the platform that you are using, they take away the 20% and go and pay to SARS, because they do have your tax number, and then the rest of the money that is left there, it is yours, right? So another way to optimize your tax is, especially with IT3 or with interest income, is to have a tax-free savings account. I also made a video about a tax-free savings account where you can go and get more information. So on the tax-free savings account, it helps you to make more interest, basically more than 23,800 without paying tax, because all the income or the interest that you get from your tax-free savings account, it's basically, it doesn't count towards tax, right? So it's only the other interest income that you get that must make the 23,000 and above for you to be able to pay tax. So a tax-free savings account is one of those things that one needs to have to optimize their tax obligation. And it's very important to understand that a tax-free savings account is a long-term thing. It's not something that you try to optimize tax for this year. It's something that you try to optimize tax for long term. So it's a vehicle to build wealth, so that when you are wealthy, you've got so much money on the side that doesn't pay tax. So tax-free savings account is not a short term where you are saving towards you going to school or saving towards you going on holiday or things like that, because it basically defeats the purpose, because there's some gates around it, because you can only basically contribute 36,000 per year, and the maximum is 500,000. Once you've contributed 500,000, you cannot go and put again. And if you take out money, you cannot go back and say, I want to replace the money that I've taken out. So because it's so gated, you need to be very, very, you need to look at it as a future or a long-term savings account. Even though it's a savings account, let's just call it an investment. It can be a long-term, you see it as a long-term investment to reduce your tax obligation. So if you can recap, what I've been saying is, to know which tax bracket that you fall under, you need to take your total cost to company, and then you remove your retirement contribution, and then that will basically give you your taxable income, and that will tell you which tax bracket you fall under. And obviously, if you want to maximize, or you want to basically pay less tax, is to make sure that whatever you're contributing to your tax, whatever you're contributing to your retirement, it's less by contributing the maximum, which is 27.5%. Obviously, they cap it at 350,000. So if your 27.5% is more than 350,000, the cap is only on 350,000. So you're only going to get the benefits on 350,000, or whatever the 27.5% that you are paying lends you to. So basically, it's your total cost to company minus your retirement contributions. So there's also other deductions that you can basically remove, but a lot of us don't have those deductions. I'll go and put in basically a text underneath, so that you can see what other benefits or what other deductions you can make to determine your taxable income. But in most places, it's your total cost to company minus your provident fund, or whatever you're contributing towards retirement. And then the dividend income, they already tax it at 20%. So whatever you get on your profile or your portfolio, your share portfolio, if they pay you dividends, that 20% is already taken, so you don't have to worry about it. And then there's interest income. So on the interest income, you can make 23,800 Rand without paying tax. Anything above the 23,800 Rand, they take 40% of it and add it into your income, and then they tax it accordingly. So for instance, let's say maybe you've made 24,800 Rand. So you've made an extra 1,000 Rand on top of that cap that you cannot pay tax. So that 1,000, they take 40% of it, which 40% of 1,000 is 400, and then they take that 400 and put it into your taxable income to see how much you must pay on tax. So for instance, if your tax bracket is 36%, they'll just take 36% of the 400, and that's whatever is left, obviously you keep it. And then there's your tax-free savings account, which is a long-term wealth building account that can help you to have more than 23,800 on tax, because the interest that you earn there doesn't form part of the 23,800 that you are allowed to make per tax year without paying tax, right? So yeah, that's all I wanted to share with you guys. I hope this video has helped you guys to know how to navigate building wealth the tax-free way, so that all of us can basically build our wealth and not have a lot of tax obligation, because you want to pay as little tax as possible. That's why you need to have these vehicles. Basically, you must have a tax-free savings account, contribute at least the maximum if it's possible towards your retirement, because when you go to retirement, your retirement tax bracket, it's much lower than when you are working. And if you retire, for instance, if you leave your job before retirement age, also that it's hefty, but there's still some benefits to it, because also your retirement fund will grow at a faster pace if you are basically contributing more money, especially if you're still young. So your retirement can grow basically quicker. So yeah, love you lots. I will see you guys on the next video.